Hey everybody, this hey everybody, this is David Skreek. Hope everyone's good. So today we're going to talk about an interesting thing. I think I'm going to talk about some of my longer term things this week in terms of what the market's going to happen. Because, so what's going to happen with the market? I think one thing that's interesting right now about what's going on in the world and a bunch of other factors, in terms of the political situation is, I think it doesn't matter who wins, that we're going to see this kind of topping in the stock market. And one of the major reasons I believe that will be the cause of our next downturn will be a potential debt crisis. Now, I'm going to show you a few things that why economics, trying to predict things can be so difficult and so hard because you can be right about a lot of things. So I want to show you that a book that spurred my interest um, in the markets. This is one of the books I liked. It's called Bankruptcy 1995. It's by a guy named Harry Figge. The first edition came out in 1992. And of course, 1992 was the year of the election. That's Ross Perot got, I think, 16% of the vote that year, roughly. And, one of the biggest third party candidates, in decades. And one of his main issues was the national debt. Now, if you want to buy this, you can buy this book for a couple dollars. I think even for a while, I think I bought one of mine for 99 cents. So, but this guy was exactly right. If you go look at the charts he has in the book what he calls it the hockey stick curve. I call it the parabolic curve of the debt. All of these things have happened, but what he failed to realize is that there would be massive money printing, there'd be financial repression, there would be all these things done to keep interest rates low as the debt um, soared. And basically, that's he was using common sense. Of course, these things aren't common sense. These things are wild. But I think actually this can be almost renamed Bankruptcy 2025. And what's funny about this book, because I think we're going to be headed there in the next couple of years. And what's interesting about this book as well um is is like I've had a similar experience as well, where I wrote my book, The Great uh Super Cycle. You can see here. And the premise I had of the book was, okay, we're going to see massive money printing, we're going to see quantitative easing, we're going to see all these things, and the stock market may go a bit higher, but I think at some point we're going to have a back increase in inflation, an increase in interest rates, and real assets, commodities, gold, silver, will start to outperform. So like that has now started to happen, but it took 13 years, and I was wrong in the regards that um I got this thing like wrong in regards that I underestimated how much they would actually cut rates and the like. You know, I really have to admit I underestimated that. I didn't think that rates would go as low as they did and really continue to prop it up. And I also underestimated all the money that I thought would go into commodities and inflation. Some of it did go into it, but really went into asset prices, real estate, stocks and bonds, crypto, went into risk assets, right? So that's basically it. So, and actually I have a book, so I have a chapter in the book called The Money Printers, and it's about how we're going to see higher yields. And of course, like that was right. Like if we go look at of course I've talked about this, like the 10-year yield. Let's get a longer term chart today, and we can see that the 10-year chart on this yield is you see this 25-year chart, and you can see these yields are over 4%. In the 10-year, you draw a line here, especially this high at 5%. That's the highest since 2006. So, I wrote this book about here in 2010, when yields were under 10%, and they have doubled, right? Since. But look at the next decade or so after I wrote the book, the yields didn't go up at all. So it's very difficult, like when these massive macro predictions, especially when you're predicting something like the superpower of the world is going to have a sovereign debt crisis. So, like, I don't think the national debt can be saved. So if we go look at this, deficit is now over 2 trillion, actually $2.2 trillion. The nearest national debt is now near 36 trillion. GDP is something like 27 or 28 trillion. So we're way north of, we're at 120%. It's like 102, 103% if you just take in what the public owns, because the Fed owns about a sixth of the debt, but with all the quantitative easing they did. You can see the interest of payments are um, uh, over $1 trillion now. And the problem is now is Social Security, you can see is 1.5 trillion. Defense war is 940. You can see interest payments a trillion. And then you can see 1.8 trillion on Medicaid, Medicare. So you take these, let's just take these, that's 3.3. Let's make this a trillion, okay? 4.3 trillion, right? And the deficit is, you can see, is 2.2 trillion. Well, let's take 4.3. Oh, and then interest would be actually 5.3 because we take interesting. So basically 2 trillion of spending is non-discretional. Department of Education, all these different agencies, etc. So you would have to cut all those agencies to zero just to get to a balanced budget. And of course, in a recession, what's going to happen is 5 trillion in revenues is going to go to like 4 trillion, and this 7 trillion in expenditures is going to go to like 8 trillion. So your deficit's going to go to 4 trillion, which is like, we're talking 4 to 5 trillion. You're talking 20% of GDP. So at some point, I think it is going to, unravel. And you can see the total debt to GDP level, because you understand, like a lot of European countries, they don't have really provincial governments. They have national governments and maybe small municipal governments. So when you see the debt to GDP of like Spain or Italy, it's kind of the debt to GDP of the whole country, because the city's debt is much smaller. So in the US, of course, the states have a lot more autonomy, and you can see the total federal, state, local spending is over 11 trillion dollars as well. And you see the debt to GDP ratio, including the debt that we have at the state and debt level, which you can see is 3.6 trillion, comes to 135%. And this debt, by the way, is owned by bondholders. None of that is monetized. So I just think it's completely out of control now. Like no one can stop this. And one thing about the whole politics thing and the thing with Trump right now is, are you like a bit of a conspiracy theorist? Like, look, I'm the furthest thing from a conspiracy theorist. I think 9/11 was, yeah, a bunch of jihadis like running the planes into the World Trade Center. I think that a lot of the poor foreign policy led to that. But anyway, we're not going to get into that right now. But where I kind of get into like this conspiracy theory, right, is who else better to have the debt crisis occur under than Donald Trump? Because then you can, like, if you want to call it the swamp or the big Wall Street money brokers who are basically behind Kamala, you can blame him for everything. Even though, like, if you go look at it, let's go back really since the Reagan administration, it's been Reagan and the Democrats in the 80s, then both Bushes, even Clinton, even he was okay because he had those balanced budgets, but that was because there were some accountant shenanigans and he had this big economic boom. Obama, Biden, Trump all caused this. And, it's also reflective of the population. People want their free stuff. They want their health care. They want their whatever, right? So I just think it's gotten to be too big, too far. So, and I think that really, look, and I go, again, you look at Bankruptcy 1995, you look at my book, The Great Super Cycle, you look at numerous books that have warned about what's going on with the debt at the national level. I just think that, like many people, including myself, it's difficult to predict this because we talk about cycles and trends. This is the long-term trend, right? This is the end of the US as a superpower. This is like the UK in 1946. This is, Spain a couple of hundred years before that. This is, the end of the Roman Empire. This is that kind of thing. And the Roman Empire, had a resurgence in the second or third, a century. So, it looked like it was done then, and then it lasted another 200 years. And of course, the Western Roman Empire, or sorry, the Eastern Roman Empire, Constantinople lasted almost another 1,000 years after the Western part fell. So these things can last a long time, and actually, I saw one of the most fascinating stats I'd ever seen. So basically, it took into account like GDP per capita, and total GDP of the world pre-colonialism, because colonialism did lead to, the real expansion of the wealth in the West, UK, France, Spain. Part of it was just stealing from the countries that took over. Part of it was, they extracted natural resources from this countries. Part of it because they built the colonies there that added to their wealth. So that was interesting about this, because, that's what expanded. But pre-colonization, GDP per capita, guess what the richest country in the world was? So this would be like 1490. It was Italy. Italy, even again, 1,000 years after Rome fell, was still the richest per capita place in the world. And what's interesting again about long-term trends is something we can talk about another time is that on a per capita basis, their incomes were only about half, but of course their populations were much longer. China and India, on a total basis, GDP basis, were easily the majority of the world's economy at that time. So this is what we're reverting back to. Like this whole thing where like because colonization and industrialization, which really happened in the West, and the UK, has about 60 million people, and it was obviously much smaller during the height of the British Empire. And the US, is a larger country, but the thing where all this wealth was concentrated in the West, that's kind of dissipating, and we're getting back to where we were historically. We're getting back to where we were, back in like I said, the Middle Ages. We're getting back to that. So it's going to be very interesting to see what happens going forward. But I think this is the number one issue. And what I'm getting kind of coming full circle here. No one talked about this on the campaign trail. That ABC debate or was it CBS? I can't even remember. That Trump had. Those moderators didn't even mention this. The number one issue that is hitting us all, right? And let's look at the world debt clocks, right? In a second. And it's happening all over the world. Canada, UK, Australia, most Western European countries. It's happening everywhere. You can see US, China even. China has 82%. Like China had nothing debt to GDP ratio. You know, um, yeah, Japan, you see 303%. Germany, 80%. UK, 110%. India, 97%. France, 129. Italy, 174. Canada, 130. So it's like this is happening everywhere. Like Australia is still pretty low. It's you can see it's 67 in Australia. But Australia had like no debt before the financial crisis. It had like 15% of GDP. Belgium's 125. Greece, 231. All that austerity, everything Greece, because they just needed a default on it. Still 231, And then you see some of these like Ireland is, because they were one of the pig countries, has rebounded very well. Because they get all that revenue from their low corporate tax, and they have a small population, so that helps them, as well. You can see Spain 136. So anyhow, I just wanted to show you that as well. So, like I think this is the number one issue. No one is talking about it. And I think like I don't know what's going to happen here with rates. Do we still see one more kind of move lower? We can see really we haven't done much on rates here in the last year or two. So did we see one more move lower to like 3% before we move higher? But I'll tell you this much: if we take out this 5% and we start going to 6 or 7% with the amount of debt now and the amount of like private debt people have too, because that will equate to higher mortgage rates, etc. It's going to crush people. So I don't think the debt problem can be saved. Ultimately, why I'm still massively bullish on gold and silver. And I think that at some point you'll see massive monetization of the debt too. But I don't want to get into that here. Here, I just wanted to talk about the debt crisis, the number one issue, the number one issue that was not talked about on the campaign trail as well. So everybody take care, have a good one, and I guess we'll have a little election update tomorrow, like a little election thing.